A very good evening, friends. I'm Sanjeev Singhal, Central Council member and Chairman, Auditing and Assurance Standard Board and Sustainability Reporting Standard Board. On my behalf and on behalf of my Vice Chairman, CA Vishal Doshi ji, I welcome you all to the 107th program of the Auditing and Assurance Standard Board for this council year. And so far, 142,000 members have attended the various programs. Thank you for your support. Today's program is on key consideration in audit of oil and gas sector. As we know that oil and gas sector is the backbone for the energy requirements of the country. So what are the key issues which the auditors can encounter while doing the audit of oil and gas sector? So that is what we are going to discuss. And today we have CA Nilesh Khemka, who has an experience of over 9 years in audit and financial accounting advisory services. And he's a member of the Institute of Chartered Accountant of India. And he has taken many programs for the Institute of Chartered Accountant of India. He has extensive experience in accounting and auditing across different industries. He is an expert in multiple gap conversion. He's been extensively involved for review of the IFRS diagnostic report. Has been involved in resolving complex accounting issues with respect to financial instrument, revenue recognition, consolidation, lease accounting, business combination, etc. And he's working on many key clients in the oil and gas sector. So we thought that he will be the right person to take us through this key consideration in audit of oil and gas sectors. So thank you very much, Nilesh, for joining in our 107th program. And I would request you to kindly start your deliberation. Thank you, and over to you, Nilesh.
Thank you, sir. Good afternoon to all of you, and my sincere thanks to Sanjeev sir and AASB for giving me chance to present my views on oil and gas sector. So here, let me just present my screen. Yeah. So as we all know, oil and gas sector is very crucial or bears an importance with respect to the India's steady growth towards the 5 trillion economic growth dream which Prime Minister has taken. So if we just see the overview of oil and gas industry in India before starting on the peculiar issues in the audit of oil and gas sector or oil and gas industry. So currently India is the third largest oil consumer in the world, whereas it is the second largest refiner in the Asia. Within India, we have IOCL, who is the largest refiner in the India with almost around 10 to 12 refineries, right? If we talk about oil and gas sector, it is out of the 8 core industries, which is of key importance for decision making on the India's growth aspects, right? Since it is a capital intensive industry, accordingly, Government of India has adopted several policies to make available the desired capital, which is like allowing 100% FDI in some of the segments within oil and gas sector. If we talk about the crude oil production, it was 29.7 MMT as of 31st March 22, which is expected to grow to 450 MT till 2030 or 32. Oil and gas sector includes various sub-cycles like exploration, then with development, production, and after all, the last is the abandonment. Since exploring the wells and extracting the oil may be hazardous to the environment, accordingly, as per the legal regulations, any oil and gas company has to abandon the oil wells after the exploitation of 100% of oil reserves. If we talk about the estimated investment within oil and gas sector, it is estimated to be more than $100 billion by 2024, out of which 58 billion is for next year and rest for 2024. It is an estimate and may go maybe beyond this level. As we said, India is the third largest consumer the oil demand is growing very rapidly. It is poised to grow to 7.2 millions barrel per day till 2030, which is currently 4.8 MBD per day. So this shows a 50% upside in the oil demand. Again, if there is a rise in the oil demand, it clearly shows the development in all the aspect of the economy, because oil and gas are the backbone of many industry, be it manufacturing process, be it real estate, be it auto industry, right? Oil and demand, again, if we see the longer horizon till 2045, it may grow on the speed of 2x from the current level. Having said that, about the significance of oil and gas sector, it is more prone to very is it is very volatile, considering the global currencies keeps on variating. Currently, the all the currencies against the dollar are on depreciation side. Accordingly, the prices in the oil and gas global market fluctuate, and thereby causing global oil and gas prices have impact on the depreciation side, depletion, because it can impact the valuation of reserves. Then the most important for oil and gas companies is the impairment analysis, as and when the prices of oil and gas go up and down. Then it is also poised with the interest rate risk, because there may be borrowings from foreign markets, there may be foreign investors, right? Again, then technological assessment and feasibility of the oil wells or oil reserves is of prime importance when we talk about oil and gas sector. These are some of the global oil and gas risk in this sector, which are categorized into these four pillars: financial, compliance. When we talk of compliance, it is there are green products coming in, right? And accordingly, there is a pressure on the oil and gas companies to adhere to the guidelines, maybe from ESG, maybe from sustainability, right? Then apart from these, there are various legal compliances also, regulatory compliances also, like we talked about the abandonment of the uh, oil wells after the exploitation, right? There are safety regulations from the ministries which needs to be adhered by the oil and gas sector. Then comes the operational part, where again different guidelines are there from the ministry which needs to be adhered while the during the manufacturing process. uh, it may be the cyber regulations also. It may be the digitization of or the transformation of all the processes uh, digitally. Then comes the strategic, which includes the long-term contracts, geopolitical concern, all using the alternate energy sources to of volatile oil prices, right? And seeking the funding from the global markets due to the capital intensive industry. This is the value add chain for oil and gas sector, which starts from the exploration. Before exploration, there is a survey which these oil and gas companies need to do to identify and locate and after they get the license from the government to explore certain area uh, beneath the earth or maybe offshore region, the exploration start. Within the exploration stage, there has to be a cost and budget estimate. There has to be ability to locate the resources under the earth. They need to include maybe JV partner also, because of the capital intensive industry and requirement of funds. The exploration is done jointly in mostly all the cases, be it ONGC, be it Reliance, be it British Petroleum, be it Shell, right? All of the companies do the exploration jointly with some other organization. Then there comes the geopolitical tension, which is of prime importance in the oil and gas sector. Uh, as the government of any country changes, it is poised to have significant impact, maybe negative or impact on the exploration activities, on the reserves, on the development stage of any oil and gas sector companies. After the exploration, this comes the in the value chain, we have production, wherein the crude oil is processed to further refine to be marketable for the use by the end customer. So it starts from the exploration, then goes through production, then entering the crude pipeline to finally reach at the refinery areas, where like IOCL, BPCL, or HPCL, where the crude oil and parameters is processed in petrol or diesel, which is used by the ultimate end consumer, maybe in manufacturing process, maybe as an household consumer we are using, or retail consumer we are using in our vehicles. So this is the value chain within the oil and gas sector. Each of these uh, standpoint, or each of these uh, parameter has their own importance. Like the exploration is the backbone, or is the starting point of this value chain process, which through the when it transfers from the exploration well, the oil is transferred from the exploration well to the refinery areas. It goes through storage facilities, transportation through maybe pipelines or maybe tankers. Again, if the oil is transferred through tanker, there is a chance of tanker leakage. If and again the spillage of the crude oil. In case of pipeline, there are chances of corrosion or leakage again. So every area or every step has its own importance and on demerits again as well. So if we talk about the types of companies within oil and gas sector, so it is divided into the three specific sectors, or three specific pillars, like upstream, downstream, and midstream. So if we see, there is a rig over here which depicts the offshore gas platform. So again, the sector is divided into the onshore and offshore. Onshore, where the exploration is being done on earth. The offshore, where the exploration activities are done on the coastal areas. So upstream basically involves the exploration of oil and gas activities. Midstream includes the activities of transporting the uh, crude oil from the exploration areas to the ultimate refineries. Within midstream, there is also an activity of refining the product before it can be transported to the refineries. So there is a requirement, a certain grade of crude oil can be transported through pipelines or tankers, and accordingly there is a minor process to refine the crude oil. But ultimately, refining is done by the companies. Within companies, the crude oil is ultimately refined so that it can be used in the manufacturing process or by the retail consumers. So this is the overview. If you can see, there is a pipeline. This is the storage tank where the crude is being stored before refining, and it getting transported to the ultimate refineries. Here, when it reaches to the refinery location, it is refined, and again, with the help through the retail outlets, it is marketed and distributed to the retail consumers. So these are the definitions which we discussed. Then if we talk about the broad overview of the oil and gas sector, so it starts, exploration starts by digging the oil well, wherein the crude oil is identified or located. Then crude oil is extracted and sent to refinery. Within refinery, there are different processes like terminals, airfield, LPG bottling plant, or other storage points from where it is sent to the bulk customers, retail dealers, retail distributors, retail customers, right? Mode of transport include coastal tanker, the pipeline, and all. These are the traditional way of transporting oil, and these transport mechanism are used throughout the life cycle in the oil and gas sector. So it starts from exploration, where we use the exploration activities. Appraisal, again, it's the once the exploration stage is successful, or the companies has identified the oil reserves under the earth, the next stage comes the development. So for the development, the activities which are being done is setting up the installation facilities, setting up the refinery facilities, so that the crude oil which is extracted from the earth, or from the well, are being treated before they are transported through the pipeline or through the tanker to ultimate refinery, right? These are oil rigs are also used in the offshore region. We have seen, it's in the picture. There is an oil rig which extracts the oil from the oil wells, and then again, after being treated at the installation facility, it is sent to the refineries. This is the this oil extraction keeps on moving, and after environment, big oil well. As we all know, the concept of decommissioning was introduced by India 16 under the India's regime, but these oil and gas companies were already recording the provision for decommissioning liability or dismantling the oil well, or any pit holes due to the legal requirement. So if we see any financial statement of oil and gas companies within India prior to March 15 or March 16, we can find a provision for the decommissioning liabilities, which involves decommissioning of or abandonment of oil wells or pit holes which are being digged to locate any or to identify any viable resource under the earth. This is typical presentation in a financial statement during the different stages in the oil and gas companies. So initially, when the exploration starts or during the exploration stage, any expenditure is being recognized as E&E expenditure, which is termed exploration and evaluation expenditure. These can be named differently by different company across the globe. Like in this case, the company has given a name exploratory wells in progress. This represents the expenditure incurred on the exploratory activities till now, which or which are in progress, right? The item which shows wells written off during the year, this means this much amount of wells have not been or the exploration activities spent on these wells was not successful, and accordingly the wells were termed as dry wells. So as per the requirement of different accounting principles, if any expenditure is incurred, let's say during the exploration phase, these can be accumulated as just like a CWIP. And if the oil is not it is not viable to dig down to extract oil, because the cost would be more instead of revenue, or let's say there is no oil at all, then these has to be charged to profit and loss account. and accordingly this line represents this wells written off during the year represents the wells or the amount of expenditure which was incurred is charged to profit and loss account due to any of the reason. Maybe the oil quantity was very less, or there may be a quantity or oil was not found in those wells. So it is not like if the oil company has identified one site where oil can be located, it is not necessary that oil will be found there. Uh, uh, Typically speaking, there are very less chances, or the chances of locating oil vis-a-vis the total activities being taken by a company, the chances are very low. There may be on very lower side, maybe 5 to 10% of the wells may be successful, and rest the companies would need to be expense of the amount. We can see over here in the previous year also around 70,000 million approximate of expenditure was charged to profit and loss account, and in the March 21 45,000 million was charged to profit and loss account, right? We can see the expenditure incurred was 43,000, but the charge to profit and loss was 70,000. This depicts lesser chances of exploratory stage being successful, or moving to the development stage. So after the exploration, it comes the development stage, wherein the wells or the facilities or the exploration activities which have been successful, or the activities based on the geological survey and other studies of the seismological data taken from the wells shows that there are sufficient quantity of oil reserves available, and it will be commercially viable to install the development facilities or oil rig therein and explore the oil wells, and accordingly these are transferred from the exploratory stage to the development, right? If we can see, sorry, there is also an impairment indicator, because once the facility comes from once the expenditure move out of the exploration to development stage, the requirement of India's 36 impairment analysis needs to be done on a well by well basis. So accordingly, as and when the oil prices moves up and down, it has direct significant impact on this stage. So as an auditor, we need to for these two steps, as an auditor, our prime suspect area would be whether all the expenditure have been correctly classified within exploration stage and development stage. Any expenditure within exploration stage which is being carried in the books as an asset relates to all the wells which may prove successful, right? So that assessment needs to be done on the reporting date, because if that assessment is wrong, we may end up doing the wrong classification, and it has a huge impact on the profit and loss account. It directly hits my profit and loss account, and the expenditure which is parked in the development stage, maybe in the development wells in progress, or maybe by other names, oil and gas asset in progress, the prime focus should be on the quantity of reserves which may be extracted, maybe sourced from that wells in future, and the expenditure which may be required to be incurred on these respective wells vis-a-vis the price prevailing in the market, and accordingly there may be an impairment hit to be taken in the case the oil prices are going down in the market, or due to the global scenarios, or due to the rising production by the other major countries. There may be pressure on the oil and gas companies, or their margins, and accordingly the impact would be on the uh, uh, development wells in progress, or the cost which is accumulated as an asset in the financial statement. ultimately, after the development stage, once all the oils have been identified, the wells have been or the facilities have been installed on the wells. These facilities and wells move from the development wells in progress to the ultimate oil and gas asset. So oil and gas asset includes all the facilities, oil rigs, other plant and machinery apart from the oils and wells, the expenditure incurred on the wells. Within this, we need to include the decommissioning liabilities as well, considering the requirement of India 16 plus the legal requirement. It may so happen that be the legal requirements. So accordingly, in the case of oil and gas companies, we need to be very mindful that we need to adhere to both the regulations, Ind AS and the other legal requirements when we talk about the decommissioning liabilities. It has to be insufficient as required by the circulars from the Ministry of Ministry of Petroleum. Uh, there is a concept of decommissioning fund as well, wherein several companies deposit or contribute to a fund, and in case of any requirement, the loan can be given from that fund, which is administered by the ministry. Plus, there also in this case also the impairment is very crucial, because it is directly linked to the oil and gas prices, any geopolitical factor, any change in the long term contracts, right? So once we move out from the development phase, the reserves are established, then as an auditor we need to segregate, or when we need to have clear cut differentiation between different type of reserves, because reserves can be proven reserves or unproved reserves. uh, because why the identification or differentiation of reserve is important, because it have direct impact on the calculation of depletion or depreciation, calculation of impairment for impairment analysis, uh, amount recognized as provision for decommissioning liabilities, and if there is any business combination during that period, or the period under audit, there could be an impact on the purchase price allocation as well, because these reserves serves the basis for calculation of depletion or depreciation, whatever name called. And accordingly, some companies may use proved and probable reserves, some company may use only proved reserves. So there is no guiding principles under any of the accounting framework which reserves to be used for the purpose of calculation of depletions or impairment analysis. But whatever the method or whatever the basis is used, that has to be applied consistently. If we talk about the proved reserves, it means the estimated quantity of reserves which are located, or which are estimated to be or which appears to be available under the earth, from or we can extract these reserves from the oil and wells where the facilities have been installed. Then these proved reserves can be proved developed reserve and proved undeveloped reserves. Within proved developed reserves, it means the reserves can be extracted based on the existing facilities. There is no substantial expenditure required. In case of proved undeveloped reserves, the substantial expenditure has to be incurred by the company. Now, if any company is, let's say, using the base for impairment analysis as the proved developed reserves, that will give the different answer vis-a-vis if we are using the proved undeveloped reserves. In this case, the substantial expenditure which has to be incurred in future to extract these reserves. So that cost has to be considered while the impairment analysis is being performed. right? And accordingly, as I said, these type of reserves or the basis of reserves which are considered for any of these calculations is very important, because they have very persuasive impact on these items. And for the oil and gas companies, these four are the critical line items in the financial statement which directly impact my profit and loss account, like depreciation or depletion, then impairment or its reversal, any decommissioning liability or restoration obligation, and lastly the purchase price allocation. These items are of prime importance in any of the company's financial statement which are into the oil and gas. So again, these talks about the expenditure which is incurred before the license is given by the company to explore. These expenditure needs to be expensed of in the profit and loss account. So as an auditor, we need to see if there are any new wells which are being the activities has been started during the year. So we need to inquire whether any expenditure which was incurred before the acquisition of license has been properly charged to profit and loss account or not, right? This need not to be capitalized. This is not allowed to be capitalized rather. Then there are two different methods which are being used globally for the cost which is incurred during the exploration stage. Again, there is no specific guidance which method to be used, which not to be used. Depending on the or considering the varied industry practice, any of the method can be used. But so these two methods are successful effort method and full cost method. If we talk about the most widely used method, or which depicts the fair presentation, it is successful efforts method. So in successful effort method, the cost is directly linked to the success of the oil wells. It is capitalized or charged to profit and loss account on a field by field basis, or the results of basis the result of a particular field. So let's say if during the year 5 and out of these 5, 2 are not successful and they are declared dry within that year only. So any expenditure which was incurred on these 2 wells should be charged to profit and loss account if we talk about successful effort method. And expenditure on the remaining 3 can be capitalized, but provided in future as and when a particular field is expected to be dried, or the company declares a particular field to be dry, the respective expenditure need to be charged to profit and loss account. Whereas in full cost method, the larger area is considered while allocating the expenses. So larger area means all the oil wells within a particular country, like let's say in India, if company XYZ Limited is exploring activities, let's say in 100 oil fields. So irrespective of the outcome of particular oil wells or oil field, they will be capitalizing the complete expenditure in their books of accounts, right? But this shelter or accumulating or capitalizing the cost irrespective of the successful or unsuccessful result of the oil well is being given in the exploration phase only. Because once the well or the facility or the oil field moves from exploration phase to the development phase, right? Then the impairment analysis has to be done on an oil well by oil well basis or oil field by field basis, and accordingly in that case that successful effort method will prevail only. Because if the company needs to do field by field impairment analysis, in that cases if the expenditure is over capitalized considering the recovery basis the oil reserves available in that particular well, then extra cost which was capitalized needs to be charged to the profit and loss account as per the impairment guidance. So accordingly, as an auditor, we need to see what type of accounting is being followed by the client. If the full cost method is being followed, then we need to be mindful for all the all the oil wells or oil facilities which are moving from impairment coming in because of capitalizing the excess cost. So we need to do comparison of cost which is already capitalized plus cost which will be incurred during development vis-a-vis the expected oil reserves from that particular well, and considering the global oil and gas market, the price prevailing in the market, and uh, and any other geopolitical factors. If we talk about the key challenges in the audit of oil and gas, uh, these are technology or the sorry technical complexity, because these extractive industry involve very complex activities which start from exploration till the actual development of the well or actual extraction of the well. Then there are different type of reserves calculations. Then there are different methods of accounting being followed in the industry. Plus, there is no specific guidance for some of these accounting issues, or any uh, specific treatment available which is standardized. That's why it posed the complexity while we audit these issues. We will see after some slides there are side track issues, there are line fill and cushion gas issues, provisional pricing. Then we have issues related to farm in farm outs. We have issues related to unitization of agreements. There are some sector specific issues for which the appropriate or adequate guidance is not available, and accordingly we need to refer to the industry specific treatment which is being done by some global players or maybe from Indian companies. Then lack of knowledge about the business. If we talk about refineries, there are are being done uh, for uh, for different type of products, right? So getting knowledge for all these processes in a go maybe challenging again. Then we may have the specialized we the shortage of specialized staff which have the requisite knowledge for the audit of oil and gas companies. And if we talk about the start of audit, so unlike other companies, there are different departments within oil and gas companies which are of prime importance and which deals different things. Like operations department deals with the tendering process, entering into the agreements. If we need to do any sort of analysis about the installed capacity, utilized capacity, crude oil mix which is used, quantity mix, these all pertains to the operation department. And accordingly, basis the historical audits being done, maybe by statutory audit, maybe by a government audit, there are some findings which are there from the audit domain of one entity. So, since oil and gas companies in India are all the government companies, they need to adhere to the DPE guidelines, Ministry of Petroleum and Natural Gas guidelines. So, accordingly, while doing our audit, we need to be we need to be mindful that all the policies and circulars or notifications of respective government department have been adhered to. there should be no non-compliance in these type of circulars or orders. Then if there are any plants or process which are idle, they should be disposed of. uh, Analysis of installed capacity vis-a-vis the actual capacity may show underutilization. The OMC's meeting on marketing development program. These oil marketing companies, IOCL, BPCL, and HPCL, there is a committee called which has the guidelines or the regulations on minimum development marketing development program. Uh, Analysis has to be done whether all the regulations or all the activities which are being governed by these MDP committee has been indicator for the impairment of certain process within the refinery sector. Then crude oil procurement, whether the procurement of the crude oil was economical, considering the large contracts, the efficient ways of handling the import, or there is any incurrence of extra cost, maybe storage, maybe transportation cost. If we talk about sales department, there are findings which provides like there was no purchase plan or proper documentation of customer orders or anticipation of customer orders, where the companies incurred additional transportation cost, uh, delay in tendering process, and ultimately the retail outlet were let's say opened in geographies which were not well connected within the city, and again losing on the revenue, right? Or improper selection of the locations, which in turn have the expenditure on the higher side, underutilization of installed capacity, non-compliance of guidelines of the ministry, then penalty charges due to non-maintenance of daily stock, which is required to be maintained as per the MDP guidelines, and again delay in redressing the complaints of the customers. So we talk about a refinery. There are audit evidence available which we can use to see the actual crude procurement vis-a-vis the grade required within the refinery. This may sometimes happen. The X grade was required, but company has sourced some other grade uh, because the orders were not placed well in time, and this may have impact on the quality of crude oil to be dispatched. Again, this may have impact on the financial statement in the form the customers demanding the discounts, or they may imposing penalty because the crude was not of the desired quality. So these are some of the audit evidence, or these are some of the documents from where we can compare or see or see the different details which can support in the impairment analysis, like budget versus actual of the crude oil sourced, the right mix as per budget, and the actual. Audit consideration which are common for all the industries, like employee benefits, componentization, leasing, and all. There are some industry specific issues in the oil and gas sector, like revenue recognition. So if we talk about revenue recognition in oil and gas sector, there is a variable component included in all the agreements, because first the settlement, the pricing is being done on an estimation basis, and actual pricing is done fortnightly. So there is a component of variable consideration in the form of provisional discount. Second and foremost is, due to decline in global oil and gas prices, the revenue estimate for the future may be impacted. for the ongoing customers contract, right? This is particularly in case of midstream and logistics entities which have their order coming from the downstream companies, or sorry, upstream companies. uh, so if the revenue, if the global prices comes down, accordingly the revenue of these companies would be impacted, and because they will not be able to collect the revenue which they estimated or they billed to their ultimate customer. So second core important point is the inventory valuation. Again, coming on from the global prices, any industry coming on from the oil and gas prices, any variation in the oil and gas downwards will increase the storage cost or transportation cost for these type of companies, because as soon as the prices goes down, the selling price will go down, and company may not be willing to sell their output at that level, and they may require the additional storage costs at storage space, and storage cost may go up. Or due to the rising prices, customer may not be purchasing, or the companies may not be purchasing enough fuel. In that case also, the storage space needs to be will be needed. Extra storage space will be needed. There may be transportation cost require to be incurred for transporting these oil and gas from the manufacturing facility till the storage facility. So this aspect need to be taken care of while the inventory valuation is being done, or while we audit the inventory part of the oil and gas companies, because it may possible these type of cost may not be considered in the inventory valuation, or for the provision purposes. Or secondly, there could be an impact of lower net realizable value, and accordingly inventory may need to be written down. So that is the important aspect which we need to take care. Like for example, recently there was the Russia war last year, Russia and Ukraine war going on. So this year only. So there was a huge impact on the oil prices globally. Before that, during the COVID time also, there was significant reduction in the oil and gas prices, or let's say there was decrease in the demand rather than prices at that time, and which forced some of the companies across globe to write down their inventory, to write down their oil and gas assets, because ultimately there was change in the forecast of the sales, or the prices, or the realizable value of the reserves, and accordingly impacting the cash flows out there. uh, Impairment analysis, again, it is linked to the there there are chances of significant reversal of previously recognized impairment in the financial statement. So as an auditor, we need to be critical while the prices moves up, steeply move up, or goes down, because both the scenario there is a huge impact in the financial statement, and more precisely the impact is on the profit and loss account directly. If we talk about exploration and evaluation, which we already discussed, so any cost which is incurred before the grant of license, that has to be charged to profit and loss account. Important audit consideration out there, because companies may be willing to capitalize their cost, because before the grant of license, significant amount is already been spent by the companies in locating the site which can be commercially viable, or technically feasible to explore and extract the oil. So if we ignore this fact, or we won't be able to catch up on this aspect, companies may end up by capitalizing this cost instead of charging to profit and loss account. Oil and gas reserve. So as we discussed, the reserves are certain quantity of the oil or other natural resources like gas or maybe shale gas, which is present in the oil wells. So as and when the oil prices again decrease or decline, the oil reserves may prove to be uneconomic, because if the oil prices goes down, entity will be required to do the analysis whether if the oil reserves are extracted and sold at at that price, whether it will be able to recover its cost in full or not. In case if it is not able to recover the cost of extracting the oil by selling the output in the market, it is uneconomic for that particular entity, and accordingly there will be an impact on the financial statement. In case material reserves are de-recognized due to decline in prices, entities or companies need to consider the effect on the depreciation or depletion and impairment analysis, because as and when the reserves are being written off or oil wells are being written off, they have huge direct impact on the depletion and the impairment. Income tax, again, coming on from the prices only, if the down, there are chances that the deferred tax assessed in the financial statement may not be realizable or may not be offset against the future tax liability because of decline in the revenue or the estimated revenue. If we are doing the audit of interim financial reporting, we need to be mindful of what tax rate is applied for calculation of the deferred taxes, right? In case of uncertain or high volatile market. Uh, where oil and prices, oil and gas in the gas entities may take the advantage of lower price by acquiring some oil and gas assets, right? The important audit consideration here is to differentiate between the asset acquisition and business combination. There may be detailed analysis required for the acquisition of certain group of assets. These may fall within the ambit of asset acquisition, or these may fall within the asset of business combination. If we have certain scenarios which we discussed for the business combination, different scenarios which are possible under oil and gas sector, but again these will be which we will discuss after certain slide, will be only illustrative. There could be uh, more number of such scenarios, and accordingly we need to very carefully differentiate between the two type of acquisition, because the accounting differs, and accordingly there will be an impact on the financial statement. Debt modification may be required if the prices goes down. Entities may not be able to recover the interest cost. There may be different hedging scenarios required to offset the interest cost or the huge fluctuation in the currencies. Accordingly, the modification in the existing debt contract may be required or may be done by the entities. So here we need to be mindful whether the change in the terms of the loan agreement uh, is a modification or significant modification as per the principle of Ind AS 109 or not, and accordingly accounting needs to be done. If there is a significant modification as per the relevant accounting standard or Indian accounting standard, the impact should be charged to profit and loss account. So till now we have seen like any impact on the oil and gas price, maybe upward, maybe downward, have direct impact on the profit and loss account majorly. Price is going down, a significant impact on the impairment, on the depletions, on the decommissioning liabilities, etc. Revenue going down in for the estimated future sales, and accordingly, again, the impairment in case of development activities, in case of oil and gas assets. These are some of the key issues. These may pose any complexity while auditing. They may not be having significant impact on the profit and loss account, but again, the accounting and disclosure from the audit perspective is very, very crucial. Some of these issues are side tracks, overlift and underlift, revenue recognition. We will see there is one important aspect of production sharing agreement in case of oil and gas companies. So revenue recognition under production sharing agreement differs from our accounting principles, although slightly. So we need to be very careful while we audit the financial statement of any oil and gas companies, because there is a legal requirement to adhere to the principles of production sharing agreement. Beside this, we can have the suspended wall, which are more specific companies, like oil wells getting dried subsequent to balance sheet date. There may be a case of license relinquishment subsequent to balance sheet date. How to treat these in the financial statement of one company may be swapped by reserves of another company. Provisional pricing. Then we have some complexity in cases of taxes and royalty. There are different taxes in oil and gas companies, like oil tax, cost oil, profit oil. These are two types of taxes. Then there is a royalty which is payable by these companies to the government for exploring the oil wells. Then unitization agreement. This is again a unique concept in the oil and gas companies, wherein two or more companies may jointly develop a larger area and thereby combining their agreements. Joint activities. This is more complex in case of oil and gas companies. Why more complex? Because although there are two type of joint arrangements, one is joint venture, one is joint operation, but identifying whether a particular arrangement is a joint venture or joint operation in oil and gas companies is very complex issue or complex task. We have several type of arrangements for the classification we will see, but again, as I said, in case of business combination, just like that, joint arrangement also have different form in the oil and gas companies, and there can be n number of arrangements. Then we have farm outs and farm ins arrangement, forward selling contracts, wherein the revenue is sold for the future at a pre-decided price. Then impairment analysis, decommissioning liabilities, we have already talked about. One important aspect is the functional currency for the oil and gas companies, which I would want to take up at the start. This is the backbone of the oil and gas companies. If we talk about the Indian scenario, while the Ind AS was applicable in India, or became effective for Indian companies, there was one such company whose functional currency was changed, or as per the principle of Ind AS, the functional currency was assessed to be USD instead of INR. So let me just start with the functional currency assessment. So as we all know, as per the requirement of relevant Ind AS, we need to okay. So unlike the previous Indian GAAP or previous GAAP, we have a standard which talks about the assessment of functional currency. Before Ind AS, there was no guiding principles to assess and decide on the functional currency as per the guiding principles. But since now there is a standard, so we as an auditor need to identify or need to assess whether the functional currency which is being considered by the company is appropriate as per the relevant India's standard. So these standards talk about the primary economic environment where the entity operates. If a company, as per the standard, if the company is operating primarily, let's say in India, that doesn't mean the functional currency will be INR only. There are several principles or several activities which we need to see, like so. There are some primary factors, there are some secondary factors. So primary factor is, or the guiding principle is, the currency of the primary economic environment where entity operates should be the functional currency. Now, if we talk about the oil and gas sector, the prices are being denominated in USD. They are being settled in USD across the globe. The oil and gas prices, if as on today, any company in India or any part of the world enters into any oil and gas agreement, largely they are denominated, they are agreed, they are settled in USD only, because ultimately it is the forces of the US economic environment which governs the oil and gas prices across the globe. Slight movement in the dollar up and down have huge impact on the oil and gas prices globally. This, apart from this, we need to also see the local government regulations. Like in India, although it is said the government of India does not control the oil and gas prices, but but in India the oil and gas prices are again impacted from the different government policies, like the excise duty. As and when prices goes down in the global market, government tends to increase the excise duty, so that the oil prices or in the retail market in the India are maintained at certain threshold. In case the oil and gas prices move upward in the global market, or the prices of crude oil move upward in the oil market, government tends to decrease the excise duty, so that again the oil prices in the retail Indian market are not going beyond a certain threshold. So although government may not be directly involved in setting the oil and gas prices for the retail consumers, but due to these policies or due to these type of taxes, government is still interfering in the retail oil and gas prices in India. Apart from this, there are other policies, like if we talk about the export parity price or import parity price, there are different line items which are again controlled by the government or the government entities, like custom duty, like freight, like if the government tend to increase the crude oil prices in India, they can change this ratio, the 80% import parity price and 20% export parity price. They may just reshuffle this 70-30. The oil and gas prices in the retail sector in any country will decrease. We can see the export parity price is being derived by this formula. Again, this premium or discount in import parity and export parity is being decided by the government of India in our case, and accordingly there is a interference of government at each and every step in the oil and gas prices. Now, if we while we were discussing the functional currency assessment, so when we talked about the primary economic environment, so let's say there is a company who is importing the crude, processing it, refining it, and selling in the open market. One could argue there is a primary economic market of or primary economic environment of India where the company is operating, because it has manufacturing facility in India. All the employees are sitting over here. They are selling their products in India. They are paying salaries in INR. They are borrowing loans in INR. The other could argue the since the crude oil is imported and it is paid in USD, uh, then the oil prices are denominated in USD. They are settled in USD. It could be USD. So there is no black and white answer or right or wrong answer for the functional currency assessment. Uh, this is more based on the judgment and estimate from the management. Uh, more This is more judgmental, considering the wisdom of the management key management personnel. So an argument could be, though it is operating in India, but again the economic forces of US market governs the manufacturing process of company in India, because ultimately the prices of oil and gas, which is the crude, which is the important raw material for the particular company, is governed by the uh, US dollar, which is again influenced by the US market or the primary economic environment of India. Another argument in support of INR could be the government has intervention in the form of different taxes. So these are the primary factors which deals with the functional currency assessment. Again, if we could not get any answer from these, then we may do the assessment of the imports, the exports, the payments in foreign currency, payment in Indian currency over a last period of 3 years, let's say, like we have done here. The revenue in INR, revenue in USD for all the 3 years, right? Then we may do the analysis of expenditure which is incurred during last 3 years. What amount of expenditure was incurred in USD? What amount of expenditure was incurred in INR? Then fund raised, funds invested. So if we cannot get any answer from the primary indicators or the primary principles, which generally talk about the primary economic environment, we may do the analysis of revenue, expense. We may do the analysis of borrowings and investment. If we still cannot get the concrete answer, we as an auditor need to discuss with the management what do they think is the primary economic environment wherein they operate. Because there could be different regulations of the government which impacts the manufacturing process, which impacts the production process, which impacts the marketing and distribution process. We may not be aware of these facts, and accordingly, before concluding on the functional currency, we need to do such type of analysis. One question could be, do we need to do this assessment each and every year? Primarily no, but if there are changes in the management's or the business processes, we may be required to do this assessment. If there is a change in the source of raw material, we may be required to do the assessment. If there is a change in the customer base, or there is a sharp change in the export or domestic sale, we may be required to do this assessment. If there is a start of the offshore activities, or let's say activities outside India, or exploration activities outside India, we may be required to do this assessment as a part of our audit procedure. Because if the functional currency changes, we may be required to restate the financial statement from the start of the company, or whenever it is practically feasible. So this was all about the functional currency assessment. You can see here the in case of primary indicators, The answer was mixed, because sales was 70% in INR, cost was 90% in USD, and accordingly secondary indicators became more important, which was giving an answer in affirmative towards the INR as the functional currency. Let's discuss about the some of the impairment indicators. Although we have discussed these already in various aspects, like reduction in the estimate of reserves. So let's say during up to the last audited last reporting date, the estimate for the reserve was let's say 1 lakh barrel or 1 lakh MMT. But during this reporting period, this has significantly reduced from 1 lakh to let's say 60,000 or 70,000. This steep or sharp decline in the estimates of reserve is an indicator that impairment analysis should be done, and there could be a possible impairment charge in the profit and loss account. Then there could be decline in the market capitalization of the entity, decline in the long-term market prices of the oil and gas. If, for example, like for due to Russian war, the oil and gas prices were volatile for large part of the year. This could be again an indicator for the impairment. Around 3-4 years back, there was an excess supply from some of the oil producing nation, which is again the impairment indicators, because excess amount of oil was there, so thereby decreasing the oil prices. Movement in foreign exchange rates, again, if the foreign exchange rates move down, or the USD depreciates, the oil and gas prices are tends to be on the lower side. There could be increase in the production cost, maybe due to the different government regulations, possibly. If if the capital expenditure increase vis-a-vis the budgeted capital expenditure, this could again be an indicator of impairment. Operational issues, right? Significant increase in the expected cost of dismantling the asset. If, as I mentioned earlier, the provision as per the requirement of Ind AS 16 may be lower, and and decommissioning liabilities or decommissioning provision as per the legal requirement may be much higher. So this could be again be an indicator for the impairment. Significant revision of the plan for the development of the field, significant reduction in the estimation of probable reserve, production difficulties that may be due to geopolitical factor, other political factors, that may be due to environmental issues. Then there could be adverse changes in government regulations and environmental laws. Government may impose higher royalty or higher taxes, right, which will again be a burden on the producer of oil and gas companies to recover from the oil and gas reserves, which may not be possible. And again, these type of indicators we need to be mindful while we are auditing any oil and gas companies. We also discussed about the royalties and income tax in the oil and gas companies. So generally, these petroleum taxes, they are categorized into two main categories: the royalties or excise taxes, and the income tax. So the income tax, as we all know, it is calculated on the profit, while the royalty or excise tax, they are generally calculated on the production, but payable on the as per the sales. So this categorization is very important, because the royalty and excise, they do not form part of revenue, while these taxes are in a way part of our revenue. Petroleum taxes are being calculated by applying a rate as per the production sharing agreement on the volume or the production of oil, which is not adjusted for the expenditure. right? And accordingly, they are out of scope for India's 12. While they are out of scope for India's 12, and accordingly, the deferred tax is not recognized with respect to the royalty or excise duties, right? Whereas the income tax is within the purview of the India's 12 and accordingly considered for deferred tax and liabilities. So these royalties and excise taxes, which by whatever name called, are in fact the government share in the production process or exploiting the natural resources, right? These are the royalties are being charged because of exploiting the natural resources or extracting the oil from the oil wells. In a let's say in a given year, if entity has not extracted a single drop of oil from the oil wells, then royalty or excise duty will not be payable to the government, because in that case there is no quantum of volume of oil available wherein the desired rate will be applied, right? So these are some of the cases of joint arrangement which are more prevailing in the oil and gas companies in India. Uh, Apart from this, there could be many more, and accordingly, an detailed analysis has to be done then as an auditor to correctly classify these as either joint operation or joint venture, because accounting again differs for both the cases. Like in the first scenario, it says arrangement produces a product and the parties are obligated to take all of the output in the ratio of their shareholding. The price of output is set by the parties at a level such that the arrangement operates at a break even level. The arrangement is prohibited from selling the output to the third parties. So this is classified as joint operation. Why? Because the design of this arrangement is to provide output to the parties, right? They are dependent for the cash flow on the venture. The parties get substantially all the economic benefit from the joint from this arrangement, and accordingly, it's a joint operation. Had it been the sharing of their profit in the or the net assets in their shareholding pattern, it could have been a joint venture. But since here the design is they are getting the output, right? It is more towards the joint operation. They are jointly doing an activity and get whatever they can extract, they are getting in their agreed ratio or shareholding ratio. Second is with the same facts, but the product is a commodity like oil, which is readily sellable in the market, right? Again, and these are purchased by the parties at market value, which will be again distributed in their shareholding ratio. Yeah. So Here, party so here it says these parties, since one is getting oil, one is getting gas. So it means they do not have any interest in the joint arrangement, but they are doing it because of the synergies for doing the joint exploration. And accordingly, it should be it is likely to be a joint operation and not the joint venture. Venture is where parties come together to jointly do for a purpose other than cost optimization. But here the real objective which looks is the cost saving or cost optimization. And just like this, there are some other examples like this. Parties have the right of first refusal. So it is the party, if they refuse, then the output will be sold in the market. This venture is for last 3 years. In the first year, parties take all of the output in their shareholding ratio. In the second, the product is sold to third parties. In the third year, again, parties take output in the different ratio. So here it has some features of joint venture because there is no obligation to sell the output to the third party. First of all, right? They can consume, or the joint venturer consumes, right? This indicate the purpose and design is not to provide output to the parties. Generally, when the arrangement is to provide the output to the third party, or the arrangement is done only to get the output, then it is more likely towards the joint operation. Otherwise, it could end up in the joint venture also. Like if we see the last one, two parties has set up a joint arrangement. One of the party takes 100% of the gas produced and market price, and other party only takes its share of profit or loss, right? So one party is getting 100% share in gas, or 100% gas or oil, whichever is produced, and the other party is more keen in the profit which is made by the entity. So here it says we need to examine all the facts and the circumstances before determining classification. What is the economic rationale behind such an arrangement where one party is interested in the output, the other party is only interested in the profit? So that assessment has to be done. What is the economic rationale? What is the business rationale behind such an arrangement? And accordingly, the decision will be taken for its classification into joint venture or joint operation. So if we talk about side tracks means, as we can see, this company was drilling from here to here. This was oil well one. Now, when this company was drilling this particular site, they came to know, or their technical team came to know, that there is a probable oil reserves near this particular oil well. So instead of digging this oil well start to here, there is a concept of side tracking, wherein somewhere in between this process they can just do the side tracking at this particular side, and if oil is found, they can be extracted from this particular arrangement only. So this is called side tracking. Now, as an auditor, what we need to do is we need to just see if there is any side tracking the company has done. If yes, then since this well number one, although declared dry, but this expenditure can remain be capitalized in the future. So if there is any expenditure which is which is this complete cost, oil well one and of this site tracking, can be capitalized. In case this oil field 2 also proves to be dry, then complete cost needs to be charged to profit and loss account. But in case of site tracking, till the time the outcome of 2 is not final, or it has not been uh, yet declared dry, then the complete cost needs to be charged to profit and loss account. So this was all. This was for side tracks. And suspended wells means the expenditure is incurred on wells for, let's say, for last 3 years, and in the current year, which is a year under audit, the management has decided, or based on the geological survey, seismological study, and the technological study of the oil quantity available under that well, it declares the well to be dry, maybe because the quantity is not sufficient to ultimately uh, uh, fully recover the cost which it has incurred, or there may be not oil at all, and accordingly these wells are suspended from the further exploration activities, and they are charged to profit and loss account. So it says, what should be the treatment of the cost incurred on the original drilling? Should these be written off or remain capitalized? So it depends on the management. If the management says we will again start drilling, let's say after 3 or 4 months, in that case it will remain be capitalized. If the management decides they will not do any further activity, in that case that needs to be charged to profit and loss account. One important aspect in case of oil and gas companies is line fill and cushion gas. So, like the pipeline or the refinery, right? There are refinery is a continuous process plant, right? So there has to be s- a quantity of oil reserves within the pipeline, within the refinery production process, uh, at minimum level need to be kept there, whether the refinery is working or not, whether the pipeline is functional or not. This is required as a or we call it as a minimum line fill, which is required to be present at all times, right? Accordingly, this will form part of the property, plant and equipment of that particular company, and this will not be counted in the inventory, because this quantity of line fill will always remain there in the pipeline, whether the oil is being transported or not. So to facilitate that, to facilitate the pipeline working in a proper condition, or a refineries process working as desired or as per the plan, this minimum line fill has to be there at all times. And accordingly, as per the prevalent accounting principles, or or industry practice, before this accounting principle came in, this particular line fill is treated as the component of that particular property, plant and equipment, and not the inventory. Then we talked about post balance sheet event. Again, there could be more scenarios. I have only captured over two over here. One is the identification of dry holes, which means, let's say the exploration activities were going on at the reporting date, and subsequent to reporting date, the well is declared dry. Now, as an auditor, what should be my judgment, or what should be my view with respect to the accounting of that, in this case, whether this is a adjusting event or non-adjusting event, right? Again, there is a varied industry practice in this area, right? uh, So if the exploratory wells in progress at the reporting date, which is determined dry or unsuccessful subsequent to balance sheet date, were based on the substantive evidence obtained during the drilling process, then it could be a non-adjusting event, right? These conditions we need to carefully examine whether these existed at the reporting date or not, right? Because if the conditions which led to the well to be dry were existing on the balance sheet date, or management estimated the well will not be successful, or it will be dried before let's say in the near future, then we may account for this, or we may treat this as a adjusting event. Second such case is the license relinquishment. The license to explore is given for some specific period of time, maybe 15-20 years. Plus, there are some conditions attached to that particular license, which the company or the entity has to be in compliant. So as on reporting date, if the management thinks or management estimates it will not be able to meet the requirements in near future, and ultimately after the balance sheet date the license is relinquished, then in this case the license relinquishment will be adjusted, considering it's a post balance sheet adjusting event, because management estimated that it will not be able to meet the desired level of uh, 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 milestone which were set by the regulator. But where on the reporting date entity estimates they will be able to meet all the deadlines, all the milestone as established by the regulator, and if subsequent to balance sheet date the license is relinquished because of non meeting the not meeting the milestone, in that case it will be a non-adjusting event, because these conditions were not present at the balance sheet date. Then one important aspect within oil and gas industry is asset swaps. Now, an entity may exchange their future production in the oil field for an interest in another field. Let's say company A is exploring in Telangana, and company B is exploring in, let's say, states of Northeast, any of the Northeast state. Now, company A can sell its or exchange its output in its oil well for the output of the company B's oil well. Now, these oil wells or oil field may be in different stage of development, different stage of or different grade of oil or other gas will be there, right? The accounting requirement are different if the transaction represents exchange of assets or the business combination, right? As we discussed earlier. Again, we need to see whether this qualifies for asset acquisition or business combination, right? What is the commercial substance of the transaction? Why the company A is exchanging its uh, uh, its oil for the company B. It may be the company A requires certain different grade of oil which is produced by a company B, and in that case it may qualify for asset acquisition. In case it is determined to be a business combination, then again the complex accounting treatment of 103 need to be applied, right? Or we may need to also think of any possibility of joint control or significant influence, right? Provisional pricing, as already discussed, these sale contracts are often incorporate provisional pricing, because the ultimate pricing is or ultimate final pricing happens every fortnightly after 2 weeks of time. So if sitting today on 19th December, a company has raised an invoice to customer X, the prices will be provisional. This is across industry. The ultimate price is calculated as the, let's say, moving average of next 14 days of the London Metal Exchange, or maybe Bread's platform, or maybe linked to some other platform. right? So this is done because prices of oil and gas are very volatile, and to remove the possibility of unusual variation, this sort of settlement is done in the oil and gas industry. So every company would be having the adjustment in their revenue subsequently after raising the invoice. This is more crucial when we are preparing the financial statement on the reporting date, because we need to accordingly consider the amount of provision for which maybe they are in the amount of revenue which is being billed on the reporting date or just before the reporting date. So it's just like cutoff procedures. Then an overlift and underlift. So as the name suggests, one of the venturer. So it's in a case of joint arrangement, one of the party may have taken the excess quantity of oil. One may have taken the lesser quantity of oil, right? So let's say there is a joint arrangement wherein there is a party A and party B. There is a ratio of 60 or 40%. So the party who is having the 60% participation right may have taken the 50% output. The other party also have taken the 50% output, and thereby there is a underlift by party A and overlift by party B, right? Um, so it signifies there's a sale of product from A to B, and accordingly A will recognize revenue and asset, B will recognize a liability for the overlift quantity, because it is an obligation to deliver oil out of the future share of output which that receive. Some of the joint agreement or joint arrangement agreement may require net settlement on the reporting date. In that case, it will be just treated like the cash outflow from the entity B to entity A for the sale of the 10% oil from entity A to entity B. So forward selling contract for the finance development. This is some sort of financing arrangement wherein the oil and gas company sells its future production today in return of some amount of cash. That cash is used to fund the development process or maybe exploration process, because it is very capital intensive process. So it is structured through a volumetric production payment arrangement, which involves which requires the oil is being sold by the entity to the investor. That investor will give cash. That cash will be used for the development of the facilities. Now let's assume there is an entity A. It has sold, let's say, 10,000 metric ton of oil to Mr. X for let's say 100 crore rupees. Now if in future that oil is not there, or that oil is not sufficient which is being sold, then it is the ultimate risk of Mr. X, and company is not required to repay any amount to Mr. X in future. So in a way, under this arrangement, the buyer is assuming significant production risk and reserve risk. So either there may be no production at all, or there may be a production but the quantity is not sufficient for which they have contracted in our example 10,000 metric ton, right? So if future production from the specified property is inadequate, the company X has no obligation to make up the shortfall. They have contracted, the Mr. X has assumed this risk of production and reserve due to this arrangement. Again, there is no guidance for such type of arrangement under Ind AS or IFRS or accounting framework in India, but there is a little guidance available under US GAAP which needs to be applied, right? So in this case, it says the seller will deem that it has sold an oil and gas interest, right? So seller company will record deferred revenue, and as and when the production is there and the buyer will lift its share, accordingly that deferred revenue will be released as an revenue in the profit and loss account, right? If the company wants to recognize gain, they can recognize gain at the time of recording revenue, right? Again, this is very complex area, and it is not very common in oil and gas companies. Some of the companies has done this in past, not in India, but at a global level, right? Farm outs, again, a farm out is a venture. Farm out occurs when the entity or the oil and gas producer, they assign some interest in the oil and gas reserve again, or the future production to any other party who is called farmee, right? This is generally done for funding the capital expenditure. The entity in whose favor this oil and gas production is assigned, they will do the development of the facilities over there, with the help of which the oil and gas reserve will be extracted, right? Or they may do the cash payment to the oil and gas producer, right? So these agreements are called farm out agreement, which are non-monetary, because the cash is generally not paid or received. Only the oil reserves are being given in exchange for the development of that area or the facility. Again, there are different accounting treatments, again, which depends on the specific facts and circumstances of each and every case. If there are proven reserves with the property which has been given as a farm out, then the oil and gas producer entity should de-recognize that portion of PPE, right? The entity in whose favor the reserves are being assigned, or the farmee because the asset relates to oil and gas company, not the farmee. So they will only recognize the expenditure. If we see this example on farm outs, there is a company N and company P who jointly is doing the exploration and development of oil and gas located in Venezuela. Company N has 18% share, whereas company B has 82% share. Both these companies have signed a joint arrangement agreement and established in manner in which the area should operate, right? It's a joint operation under Ind AS 111, it is mentioned, right? The companies have entered into a purchase and sale agreement. So they have entered into purchase and sale agreement, which is again farm in, farm out, where they are each selling their 40% stake to a new investor, company R. So 45% of 18, 45% of 82, which jointly become 45% out of this 100%. These percentages are accordingly reduced. Company N receives cash of 4 million, it receives cash of 20 million. The three companies entered into a revised joint development arrangement to establish right and obligation of all three parties. Each party to the joint development agreement is liable in proportion to their interest for cost and cost subsequent to the date of agreement. However, 75% exploration and development costs attributable to N and P must be paid by company R on their behalf, right? So what it is saying, the 75% of the cost which account for the N and P has to be borne by R. Total capital budget for the exploration and development of the asset is 200 million. Company and share of this based on this product interest will be 20 million, right? 10%. Company R will be required to pay 15 million, right? Because 75% will be borne by R. So 75% of 20 million has to be borne by R because they have given this share to company R. The carrying value of asset in the company's ends financial year is 3 millions. So here it says company N will reduce carrying amount of oil and gas asset by 4 million because they have received cash. 1 million is excess over the carrying amount is credited to income statement. 15 million of future expenditure which is paid by company R is not recognized as an asset. As noted, this approach would be consistent with common industry practice. So generally, this approach is being followed by many participants across industry. Second approach would be company N will recognize the 4 million as above. In addition, it will recognize intangible asset or receivable for the future expenditure, which is 15 millions. So in this case, they are saying either they can also record the receivable and intangible asset. Third approach would be again recognize the 4 million. When the future assets are completed, they are recognized in the balance sheet and a gain of same amount in the profit and loss account. So the difference between the second and third is in the second, they are saying to record upfront intangible asset or receivable and a corresponding gain in the profit and loss account. But in the third approach, they are saying the same thing, but timing is different, which is uh, uh, at the time when the facilities are completed. So again, varied approach is available, which is being used by various market participants across industry. But we need to see which is more logical and accordingly account for or see the accounting treatment is realistic while we audit the financial statements. The joint operation we are done. The unitization of agreement. Unitization occurs generally during the exploration stage or sometimes development stage because of the huge expenditure involved again, right? So two entities, they are into the exploration and into the nearby area. They can combine the adjacent areas or they can combine the full areas and do the joint exploration and share the cost of exploration or development because there will be synergies, right? These unitization of these exploration activities are done to optimize cost, reduce overall expenditure. Government also insist or also provide guidelines to unitize or do the joint exploration, right? Sometimes there may be cash payment between the participant where the production or the development is insufficient to true up the adjustment or true up the contribution, right? This is generally accounted for as a contribution of asset. So if we see this example, there is a company A and company B. They owned adjoining oil prospects, Alpha and Delta. Both prospects were in exploration phase with no proven reserves. The companies entered into an agreement to develop the prospects jointly and the combined area Omega, which is considered to be a joint operation. The initial unitization agreement stated that each was entitled to 50% output. This allocation was subject to future redetermination when the exploration of Alpha and Delta was complete and proven reserves were determined. Additional determination would take place on ongoing basis after that as production commenced and reserves estimated were updated. So this is the situation. Initially 50-50, then they redetermined after some specific interval of time 40-60. exploration cost 5 million, 5 million. Future development expenditure is 40 million. The companies have agreed that they will take a share of future production in line with the new determination of interest. Additionally, the true up of cost incurred will be made by adjustment to future expenditure rather than immediate cash payment. So they are saying they will apportion this cost in this redetermined cost ratio instead of 50-50. Prior to redetermination, company A had capitalized 5 million cost incurred as an exploration cost and transferred this to tangible asset when proven reserves were discovered. How company A account for the redetermination? So company A has incurred expenditure of 1 million greater than the share required by revised allocation. So here, out of this 40 million, this company needs to account for only 4 millions, but they have accounted for 5 millions and they have already capitalized the 5 millions. So it says 1 million is greater than the share required by the revised allocation. So this 1 million receivable from company B. The agreement between the companies indicate that this will be trued up by adjustment to future development expenditure. That means company A will only be responsible for 15 million of future spend. So in future, this company needs to spend 16 million, but they have already incurred 1 million extra here. So in future, they will only incur 15 million, right? So this 1 million will get adjusted in future. Since they have said this there will be no adjustment due to immediate cash payment. That's why they are settling this 1 million in future. Rather, they can also do the cash settlement over here. This is also allowed, but again, depends on the agreement between the parties, how they are doing the or framing the agreement. Then depletion, depreciation, and amortization. Again, these are the basis of this depletion or depreciation is the calculation of reserve. So we need to be very mindful while we do the calculation of depletion, because these will be based on the category of reserves which are taken. So it says if an entity does not use proved developed reserve, adjustment is made to the calculation of amortization, right? So generally we need to take the proved developed reserves. If we are taking any other reserve, then we need to again do the adjustment in the cost part. Sir, an entity may use one reserve basis for depreciation and subsequently determine that alternative may be more appropriate, right? So in that case, the reserves basis can be changed, provided that is being done systematic basis or used on a systematic basis over the years. Though change in the category of reserve is an accounting estimate, it is not an change in the accounting policy. So it will be done on a prospective basis. So these are some of the examples from the business combination acquisition, wherein it says there's an incorporated entity which has one asset in the exploration phase, but the group does not have production license yet, right? So there is no input. Process are there, but sorry, exploration program is there, but there is no process because there is no production plan. There is no output. So it should be an asset acquisition. Likewise, there is a listed company with a portfolio of properties. All exploration activities, these have been suspended. No properties have moved forward into development. Again, no input, no process, no output, judgment required. Listed company with a portfolio of asset, active exploration program in plate, and there are prospective resources. Company normally develops properties to production. So input is the product portfolio and the employees. Process, there is no active process yet because there is no development, but they may enter into the development soon. Output, it says production has not begun. However, there is an active portfolio, and depending on this, the judgment is required whether it will classify for the business combination or an asset acquisition. Likewise, there are some more example like listed company, the property in development phase, some reserves and resources. So this will this may qualify for the business combination because all of the three elements exist over here. Alliance with another company to develop a property. So this is an alliance, not an acquisition, right? So it should be jointly controlled asset, not an asset acquisition, not a business combination. So this was all from the discussion from the oil and gas. Although this is very peculiar or very significant sector, and we can discuss at length without any limit, but due to the time constraint, I need to stop here. Anilji. Anilji, are you there?
Hanji sir, hello.
Hanji sir, I am done, sir.
Can you hear me, sir?
Yeah, sir, I can hear you.
Can you hear me, sir?
Yes, sir.
Thank you so much, sir. Sir, thank you so much for wonderful deliberation. So I have received certain questions. If you allow, can we raise the
Yes, sir.
questions, sir?
Yes,
Yes,
sir.
sir.
Yes, sir.
Sir, first question is how to ensure quantitative information provided
Sorry,
by
sir.
management.
How to ensure quantitative information
Provided by management is correct.
see again the quantitative information, as I mentioned, the quantity of reserves will be estimated by the technical reservoir engineers, and we as an accountant may not be able to estimate the reserves out there in the oil fields or oil wells. So what as an accountant we can do is we can just do the sense check of the previous calculations over the years, and see if these are consistent with these, or that's as an accountant we can do.
And what about this, sir, to verify loss or gain in exchange variations?
Sir, that should be treated differently in the different aspect. Like if we talk about the exploration stage, where we are doing the joint operation with one of the party, right? So at that point in time, my share will be part of the exploratory expenditure, and the loss and gain and loss applicable to the joint venturer, we need to recover from him.
Okay, sir. Sir, you have discussed about the wells. Can a company manipulate by showing unprotected wells into the highly protected wells also?
Yes, sir, they can very well do, and that's the area where we as an auditor need to be very vigilant and very cautious mind. The wells which are moving from exploratory phase to development phase, we need to verify these at length with all the supportings, all the technical certificates, right? Because that's the area where there are chances of manipulation.
Ji, ji. Sir, can you enlighten us on the permission charges and other expenses to be capitalized in respect of the pipeline?
Sorry, sir, come again.
Can you enlighten us on the permission charges and other expenses to be
Permission
capitalized in
charges
respect permission charges and
for
other
pipeline.
expenses relating to the pipeline?
So again, the pipeline is clear cut in property, plant and equipment as per India 16. So we need to follow the cost principle of India 16, which says purchase cost and any directly attributable cost. So if I correctly understood, permission charges would be payable to the government for getting permission to lay the pipeline, right? So in a way, these relates directly to the laying down of the pipeline. So these can be capitalized. For the other expense, we need to see each and every expense, considering its nature and why they are incurred. if the expenditure was necessary to be incurred for the pipeline to be laid down, then they should be capitalized.
So last question one member is asking, can you throw some light on Ind AS, which Ind AS is applicable in this industry?
Right, sir. So during the exploration, so I just giving the background, before the Ind AS became effective in India, so there was a guidance note on oil and gas, which was being followed by the oil and gas industries in India. And after the Ind AS were effective in India, there is a standard called Ind AS 106, which is applicable during the exploration phase, or all the exploration and evaluation expenditure have to be dealt with by the with respect to the Ind AS 106. Ind AS 106 in itself does not prescribe any accounting. It says whatever accounting policy companies following before the Ind AS or under their previous gap, they can continue following this. So whatever accounting the companies were following by virtue of the guidance note on oil and gas is released by ICAI, the companies are following same accounting under the exploration phase. Once the wells move out from the exploration phase to the development phase, they can opt the accounting of Ind AS 38, because that's an intangible asset for me. For the facilities which are installed, the machinery which are installed, I need to follow Ind AS 16 and Ind AS 36 for the impairment analysis.
Right. So these were the questions relating to the today's deliberation, sir. On behalf of AASP of ICI, I extend my heartiest thanks towards you, sir. And
Thank you, sir.
hats off to you for such a wonderful deliberation. You have covered all the aspects relating to the oil and gas sector while taking into what audit considerations are required. And once again, thank you so much on behalf of AASP of ICI. More than 2,900 members are, more than 2,500 members are live, and you have justified with your presentation as well as with the questions. Thank you so much, sir.
Thank you, sir.
Thank you, sir. Thank you. Namaste.